Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm Neziol Patel. Well, Canadian investors have certainly grown fond of exchange-traded funds. In 2021 alone, more than $50 billion flowed into ETFs, lifting assets under management to more than $300 billion. But with 1,000 ETFs to choose from and hundreds more launching every year, how does one decide which one to pick? And are ETFs always the better choice compared to mutual funds? Danielle Neziol is Vice President of BMO ETFs and focuses on ETF education. She joins me now to discuss what Canadians need to consider before investing in exchange-traded funds, the growth drivers and trends in the space we can expect. Danielle, great to have you on.
So happy to be here. Thanks, Neziol, for having me.
So let's start with the growing popularity in ETFs. Like I said, record inflows. We actually saw record inflows in 2020, and then it was topped in 2021. Can you talk to us about what's been driving this?
Absolutely. So you said it, 2021 was another record-breaking year. We saw $53 billion go into ETFs in Canada, but this is also a trend we've seen globally as well. All over the world, investors are really searching out ETFs. And there's a few reasons for this. And I think the first is that we've seen very, very strong equity markets over the last couple of years since the rebound from the initial COVID pandemic crash. And a lot of investors are sitting at home thinking, how can we get invested and how can we participate in this market growth? And ETFs are just such an efficient tool for investors to get this done because of all their benefits, their easy access points to markets. They offer liquidity, diversity, and they're very easy to use.
So what type of ETFs are Canadians buying, Danielle? Is it typically broad-based index funds, specific sectors, international?
Yeah, that's a good question. So when we look at the flows from 2021, the first big trend is equity ETFs did take over 50% of all those flows. And that's not surprising to us because equity markets were so strong and a lot of investors are looking to participate. But within that, there are some other trends that we're kind of seeing play out. One of them is socially responsible investing. ESG ETFs, environmental, social, and governance trends, are becoming more top of mind for investors. Sectors, like you mentioned, investors are looking to pinpoint a specific sector that might have some tailwinds in this kind of macroeconomic environment. And an ETF is a really great tool for them to pinpoint a sector, get a basket of companies within that sector instead of having to pick a specific stock.
Okay.
Another trend we saw in 2021 is crypto assets making their way into ETFs. In Canada, our regulators were the first to allow this. And so we saw about $5 billion in assets flow into crypto ETFs, which is a pretty large number considering a lot of these ETFs aren't even a year old yet.
Yeah. Well, it makes you wonder, though, do you get a sense that the growing interest in ETFs is because people feel more educated and confident in what they're doing, because there's such a big narrative around do it yourself, right? Or do you get a sense of some of that could be that FOMO, fear of missing out?
Yeah, I think we're seeing a lot of direct investors' interest pick up. And this is one of the growth trends we saw kind of play out over the last 18 to 24 months. So ETFs have been very popular amongst institutional investors, amongst advisors for the past decade. But direct investors are really starting to use them as well. We're seeing direct investors really educate themselves on the benefits of ETFs, understanding how to use them, and using them in their discount brokerage accounts to kind of access markets.
Have you seen that tools have made it easier for people to use them?
Yeah, so there's many resources online. So at BMO, we actually offer a lot of educational resources. We offer weekly webinars for investors to tune in and learn about what's happening in the market. We have our comparison tool on our website at bmoetfs.com, where investors can actually go and compare up to 5 different ETFs and look at all different metrics and characteristics to really understand or look under the hood, as we say, kind of learn what's that ETF holding, what's its strategy, really understanding it before they put it into their portfolios.
All right, so we are going to actually go through that tool and help people understand some of the things that they should be looking for. But right now, we're going to take a quick commercial break, and we'll be right back. Welcome back. Danielle, I want to use this block to discuss how investors even begin to evaluate ETFs, because there's close to something like 1,000 funds to choose from, right? 40 fund sponsors. And the feedback I get is that it can feel very, very overwhelming. People don't know what to pick, and then it leads to this analysis paralysis. So maybe we can start by you explaining or reminding people what differentiates ETFs from mutual funds.
Sure. So an ETF and a mutual fund, the similarities there are they are funds that hold a basket of equities or bonds. Now, the main difference between the two is that an ETF trades on the stock exchange. So it trades like a stock intraday on the exchange when market hours are open. A mutual fund is purchased, the price is marked at its end of day net asset value, which is marked at the end of the day. And usually there's accountants and there's a team of people pricing all the holdings in that mutual fund to give it its end of day NAV. Now, an ETF, because it trades intraday, it has a market price, which a mutual fund won't have. And that market price can move throughout the day, and it reflects the underlying holdings, how they're moving in the market. So with that, there is a bid-ask spread that's involved with an ETF. It's usually quite small, like 0.03% or 0.04%. But that's also a trading cost involved with purchasing an ETF. But that bid-ask spread really tells you how liquid the ETF is, which is a big benefit for ETFs, that liquidity.
Yeah, and Danielle, I think one of the important things as well is if you're outside at least tax shelter, like your TFSA and RSP, one of the things with ETFs is you can control the timing of when you're going to get hit with taxes as well, right? Because it does trade like a stock, so you decide when you're going to sell. Is that right?
That's correct. So you can sell a mutual fund or an ETF in the same day. Yeah. It's just the price of that ETF is marked throughout the day with that market price that does shift around, whereas the mutual fund has that net asset value. It's determined at the end of the day after market closes.
Okay. One of the things that I have seen is that a lot of mutual funds have been getting more into the passive side of trading, and ETFs are getting more to the active side of trading, right? They're not necessarily all like employing a passive strategy. Can you walk us through that, the active versus passive, and what makes sense? What should someone look at?
Sure. So historically, in the mutual fund world, what you would have is you'd have a fund manager who would use his or her expertise, and they would have a team of analysts, and they would use a strategy to pick what they think are the best equities or the best bonds within a specific fund. And the goal would be to outperform the broad market. We say this is providing alpha. Now, what ETFs got really popular for were they were providing index-like returns. So this is returns just like the broad market. So you can own an S&P 500 ETF and you get the exact returns of the 500 largest stocks in the US. Whereas an active manager might want to try to pick 50 of those best stocks and try to beat out the passive. So what we're seeing is actually investors using both and using them both in portfolios, sometimes an indexed approach for more of a core part of the portfolio, and then adding tactical satellite positions that are active strategies around that core to kind of tilt the portfolio, provide a little more alpha. But we are seeing both ETFs and mutual funds now, both interchangeably using passive and active strategies. And it's really all about the vehicle of choice for the investor. What do they prefer to use? Would they rather the mutual fund or would they rather the ETF?
Yeah, yeah. And there's so much focus on fees, isn't it? And we know that fees are important because it does erode your returns and creates this drag on the compounding effect. But it's still really important, especially if you are using ETFs and a do-it-yourself strategy. You still have to know which ones to pick and how to create that portfolio, don't you?
Correct. Yeah. So fees are something in the ETF space, which have become very, very popular because fees are very low in ETFs. And if you think about something like a broad beta ETF, like an S&P 500 ETF or a broad market Canadian equity ETF, you're looking at fees that are as low as 0.05%, 0.08%. So
Yeah.
very, very minimal. I think the mutual fund world got not a bad rap, but there are legacy funds who have much, much higher fees.
Okay, we're going to take a quick break. We'll be right back. Welcome back to Strictly Money. I'm here with Danielle Neziol, Vice President of BMO ETFs. Danielle, you were talking about a tool that BMO has that helps investors compare different ETFs. So let's take this block and walk through that. First of all, where would they find that tool? It's a BMO ETF site, is that correct?
Correct. So BMOETFs.com under our tools. We actually have 3 tools. Today we're going to talk about the comparison tool.
Okay. Okay, so let's walk through that. If someone uses that tool and we have an example where they're comparing 3 ETFs, we're going to pull up that board. So walk us through what they are seeing here and how they read this.
Sure. So what we decided to compare here are 3 emerging market ETFs all listed in Canada. So we
Okay.
picked ZEM, XEM, and VEE. So for an investor in this example, maybe they're thinking, I'd like to add exposure to emerging markets to my portfolio. I'd like to use an ETF. There's so many out there. So I'm going to start to compare them to understand the differences. So the first, there's a lot of things we can look at in this comparison tool, but the first thing that I wanted to highlight is looking at the ETF's objective and really understanding its strategy. So this will give an investor an indication, is it tracking an index or is it active? In this example, the 3 ETFs are all tracking an index. It's listed right there. And you can actually research more about that index if you'd like to learn more about it. Google it and go to that index provider's website. But that's kind of a first consideration to getting to know the differences between ETFs.
Okay, so yeah, objective, they always say what index they're tracking. Does it usually give any other type of information in the objective part?
The objective will say exactly what the ETF is setting out to do. So
Okay.
in this case, it's setting out to provide performance of emerging market equities. Sometimes the index is listed in the objective. The index is usually always listed in the strategy. And the strategy usually tells you how is this ETF going to meet its objective. So quite often that index tracking, that's the strategy in meeting the objective.
All right. So the next board we're going to bring up is the one that a lot of people pay attention to, and that's the fees, right? So let's pull that up. How should one read the fees?
Right. So I think it's a consideration for sure to know your fees. There is an MER or a management fee. So the management fee is what the fund provider charges to put that portfolio together, to rebalance it, kind of the day-to-day maintenance of the portfolio that the investor doesn't have to do. So that's what you pay in a management fee. And the MER, usually the biggest difference here is there's some tax added as well. So it's usually about 13 or 14% higher than that management fee. So when we look at MERs, definitely a consideration, but as we might see, as we dig a little deeper here, not the only consideration to make.
No, and it's not, right? Because there are some reasons why some ETFs do charge higher MERs, right? Especially like I know I've seen where if they're tracking an index or a niche market that may not be as liquid, we know that just the cost of trading is higher. Is that correct? Are there other reasons
Yeah.
as well?
Absolutely. So, for example, an emerging market index or ETF would have a higher fee because our portfolio managers are now going out and buying stocks in all the different markets in China, in Taiwan, in India, in Brazil. So that takes a little more work than if you were just to be buying the stocks in Canada for a Canadian equity ETF.
Okay.
So those are some types of things that make a management fee higher or lower than others.
Okay. We have about a minute until commercial break. So let's bring up the last one, which is the chart comparing the three. And it looks like
Okay.
they're tracking pretty similar.
Right, but they're not on top of each other. So you're seeing three emerging market ETFs. We saw a few differences. There's different indexes. So VEE tracks a FTSE index, and then ZEM and XEM track an MSCI emerging market index. So already you're seeing those indexes are performing differently. And one of the big reasons in this case is because the FTSE index doesn't include South Korea as an emerging market, whereas the other two track MSCI are including South Korea. So that's adding some difference. And then, of course, the fee. So XEM is the higher fee. So you can see that's really pulling back or providing a leg on its performance as well. So the fee impacting, but also that strategy impacting performance as well.
Okay, we're going to take a quick break. We'll be right back. Welcome back. Danielle, we were running through the tools and objectives as well as MERs. And one of the important points we want to make to our viewers is that this is where you can find all of this information on fund fact sheets. Is that correct? ETF fund fact sheets, because what I look at it all the time because I see that there's a wealth of information there.
Yeah, that's correct. So those are actually regulated documents that each ETF provider has to publish. But you can also find all this information on the provider's websites. Each ETF provider has a pretty good website that investors can go to and find all this information and even more than what is on a fund fact sheet as well.
Okay, so let's switch gears and talk about some of the trends that investors can expect in the ETF space. And one of the things that I was reading about, Danielle, is this asset allocation ETFs that seems to be growing. Can you explain what that is?
Sure. So we're seeing asset allocation ETFs really, really pick up momentum, especially in the direct investor space. So what an asset allocation ETF is, it's an ETF that holds 7 or 8 or 9 broad market ETFs, both equity and fixed income, within a single ETF. So it's really a one ticket solution for investors to go out and get access to global equity and bond markets. They're very cost efficient. You know, they range between about 18 basis points and 20 basis points for their management fees. So a very easy to use solution for investors to add to their portfolios for instant diversification.
So do they work a little bit like target dated funds, or because target dated funds, the asset allocation changes as you move towards retirement, right? Or is this for someone, you have it and then you got to sell it and move into a different type of asset allocation ETF?
Right, it's the latter. So
Okay.
you can get an asset allocation ETF that has a specific asset allocation between equities and fixed income. So you can go an income one that's way more weighted to fixed income, all the way up to conservative, to balanced, to growth portfolios, and even all equity portfolios. So an investor can choose what's the best asset mix for their risk profile. And then when they're ready to evolve out of that, they'll sell that ETF and then perhaps purchase a different one down the risk spectrum.
Okay. At the beginning of the show, you had talked about one of the trends that I think a lot of people have seen is crypto ETFs. A lot of interest in crypto ETFs. How do you see this evolving, and what advice, I guess, would you give to someone who's interested in this?
Right. So I think bringing crypto ETFs to market really just was another proof point of how ETFs are such a great tool to provide investors access to hard to access markets. We know we saw this in fixed income for many years. And now we're seeing investors, they don't have to open up a digital wallet. They can just buy a crypto ETF right in their brokerage accounts. So that makes things a lot easier for investors. Now, for investors looking to add crypto ETFs to their portfolios, this is a very, very volatile asset class. So that's something to keep in mind as they decide if this is right for them, and then how much to allocate as well. Because what we saw in 2021 was wild swings in crypto pricing with Ethereum and with Bitcoin. So investors should be well aware of the volatility that this asset class offers.
And if I'm correct, Danielle, the crypto ETFs, they don't follow a certain benchmark, do they? Is it more around they have to look at the fund fact sheet and actually see what they're invested in, the holdings?
So they actually will hold the physical digital asset. So we've seen this method with gold ETFs, where you can actually buy gold ETF that holds gold bullion.
Yeah.
So kind of a similar idea there, where they're actually holding the digital asset. But maybe I'd even encourage investors to read the prospectus of these ETFs, because the risks that are involved in them are a lot different than a plain vanilla ETF. So just be aware before getting into this space.
All right, Danielle, appreciate your time today and your insights. Thanks so much.
Thanks for having me.
Danielle Neziol of BMO ETFs. If you have any thoughts or questions about today's show, send us an email. Until then, stay well, stay wise, and stay wealthy. Thanks for watching.